Hi, and a very good evening to everyone. Firstly, I would like to thank all the esteemed partners who have joined us today for this webinar on the Monetary Policy Code. The objective of this session would be to understand in detail the various aspects discussed in the monetary policy meeting, which got concluded today morning. For that, we have with us Mr. Parijat Agarwal, who heads the fixed income function at Union Mutual Fund. We also have our CIO, Mr. Harshad Patwardhan, on the call today with us. My name is Ishan. I work in the products team at Union. Without taking much time, I'll hand it over to you, Pari sir.
Thank you, Ishan, and warm welcome to all the participants. So today we had the Monetary Policy Committee meeting outcome, and what were the decisions we'll just discuss in detail. So let me share the PPT that we have prepared for you all. I'll share that one. Yeah. So today's policy was on the expected lines, and what we were expecting, in fact, that RBI would stay cautious, and exactly on that line, I know the the MPC maintained the policy rate at 6.5, and similarly that SGF rate, which is 25 basis lower than the repo rate, has been kept at 6.25, and MSF rate, which is 25 basis above the repo rate, has been retained at 6.75. But one important thing to note here is that this time the decision was not unanimous. It was 5:1. So 5 members voted to keep the policy rate unchanged, and 1 member voted for the policy rate to be reduced by 25 basis points. So that's one change which needs to be kept in mind for the uh, forward trajectory of looking at rates. Second, the stance. Basically, markets were quite bullish, or had expected that the MPC would change the stance from withdrawal of accommodation to something like neutral, to signal that now the rate cut would start sooner. However, the MPC decided to keep the stance same of withdrawal of accommodation to ensure inflation progressively aligns with the target while supporting growth. Here again, the decision was not unanimous. 5 members voted to keep it same. 1 member voted it to make it or turn it to neutral, to give it a signal that pass through of 250 basis points of rate tightening has already been done. However, our assessment is that although the macroeconomic fundamentals have improved, the MPC decided to stay cautious depending upon the uncertainties in the entire global system based on geopolitical systems, and any untoward supply shocks which may come in from food or fuel. In terms of the the growth projections, what was noted here is that the MPC was quite bullish, or there's quite upbeat on the growth numbers. In fact, if you see, the MPC has progressively in the last 3 meetings has upped the full year projection for the this financial year. So it was 6.5 in October 23 policy, which was moved up to by 50 basis point to 7%. And now in this policy, it has been further up by 30 basis to 7.3%. So the growth projections have become very, very resilient, and it looks very attractive. So for the full year of this financial year, that is 23-24, the projection is that the GDP would grow. The real GDP is expected to grow at 7.3%. And similarly, for the next financial year, that is 2024-2025, the full year growth projection has been kept at 7%. Now, there has been some changes in the quarter over quarter. So for the first quarter, it could be 7.2, and then gradually it moves towards the 7% mark, 6.8, 7, and 6.9. So for the full year, again, it is at 7%. So what we see here is that the projections for the growth has remained very robust, and it is expected to remain around 7% and above for the coming years also. So that is a very, very healthy sign for our macroeconomic picture. Now, what was the reason that the MPC looked at these numbers, or they projected at such a healthy growth numbers? A, the capital expenditure done by the government, the various PLI schemes, and the robust demand from both the urban segment and also the from the rural segment, which is coming in, has kept the demand buoyant, and it is also visible in the various high frequency data points, which shows that the growth has continued to move ahead, both in the internal sector and the external sector. Now, if we move towards the second aspect, which is what as I just mentioned, the factors supporting growth. So manufacturing sector gained strength with easing input cost pressure and pick up in demand conditions, which I just mentioned. Both the urban and rural both are showing that. The PMI data, which was 56.5 in Jan 24, was higher than 54.9 in December 23 for manufacturing, is actually displaying expansion along with strengthening of future activity index. Now, this future activity index is actually for the full 1 year. So this is given by the RBI. So they are very, very positive about that. The expansion is expected to continue in the future also, because that is how the index is showing. If you look at the service sector activity is expected to remain extremely resilient, and on the back of strong domestic demand and stable global prospects. The PMI for services rose to 61.8 in January 2024 from 59.0 in December 2023, with the rate of expansion picking up to a 6-month high. So both the manufacturing as well as services are in a expansionary stage. So that's where these are the factors which are showing that our GDP, real GDP, is expected to continue to grow at upwards of 7% this year as well as the next year also. Now, one very important data point to understand how your economic growth is happening is to look at capacity utilization, which stood at 74% in Q2 2023-24. It is the long-term average is 73.7. So there also the economy is moving at almost full throttle. That's what the data is indicating. The GST collection, which is also an indicator how your economic growth is happening, or at what rate the growth is or economy is expanding, is GST collection expanded by 10.4% YOY to 1.72 lakh crore in January, to a record second highest collection ever. So if you look at the trajectory of GST collection, it has continues to rise slowly and gradually over a period of time. So that also tells us or gives us a lot of confidence about the growth in the economy. Now, the investment cycle is gaining steam, aided by sustained thrust on government capex. So what we had seen last year, the government continued to push in their budgetary announcement that more would be spent on capital expenditure. And this year also in the budget announcement, they have said that it will be increasing by close to 11% over the last year. So increasing capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as protection linked incentive. These are all actually helping the economy to expand at a faster rate. So all these the policy measures are actually helping the growth to continue and to remain extremely resilient. Now, there are certain risks to our projections or even to the MPC's projections, which can impact the growth numbers, what we are just seeing now. First is that global economic slowdown. But what we have seen today is that in the largest economy, the US, that what was earlier expected that there could be recession in that economy, But what it appears is now is that there could be a soft landing and the economies will continue to expand rather little slowly compared to what the numbers we're seeing today. Barring the the impact which may come from China, which is actually into a deflationary zone, and the numbers are not looking very attractive. Now, volatility in global financial markets. This is again one factor which can impact the entire global growth. Protracted geopolitical tensions, what we have seen, which is happening in the Middle East, if it remains for a long period of time, or for example, the movement or the ships through the Red Sea becomes a little difficult, or more have to move through the uh, along the Africa. So then it will become very challenging, and then it could impact. Now, extreme weather condition. This is one thing which is going to take a more serious note, because this actually impacts the food production, and then it increases the cost of living. So this is one factor which can impact the overall growth numbers, because then the ability for the central bankers to cut rates gets diminished. Similarly, the various credit and deposit numbers are also showing us how the economy is expanding. So if you look at the credit growth, it is at a multi-year high on the back of economic expansion, increased capex, and a push for retail credit. So if you look at this number, it is actually looking very healthy. So please look at that 16.1, not at 20.3, because that is excluding the merger of HDFC. So 16.1 is actually a multi-year high, the credit expansion. Similarly, credit growth was led by higher personal loan demand and increase in lending to NBFC segment. So the corporate credit growth is happening somewhere around 10 to 12%, but the retail is happening upwards of 25%. Sometimes it is closer to 30%, that is which is happening. So that's what is actually pushing the non-food credit to such numbers. If you look at the deposit growth, it has also increased from a low of 8.2 from Jan 23 to closer to 12.4%. But still, the gap between the credit and deposit remains, and that's one reason that we see that the short-term CD rates have remained elevated, because a lot of funds are required with the banks to for credit. See, unsecured personal loans and NBFC segments could witness a certain level of cooling of due to the recent RBI notification, which we had seen some time back on the risk weights. Currently, capital levels are quite comfortable for banks and NBFCs, so we do not see any risk coming from there. So we expect the credit expansion to continue, maybe slightly lower, but it will continue to be in the range of 15%. So that again, tells us that the economic expansion is happening at a healthy rate, and our projection of 7% looks quite credible. Now, these were all about the projections about the growth, how the growth is looking, and how we can expect going forward. Now, if you look at the inflation, because this is one of the key pillars for MPC, because MPC's mandate is to anchor the inflation at 4%. So now in this policy, the RBI has kept the full projection at 5.4. So if you see here, for the last 4 policy meetings, the MPC has kept the projection for the full year of this financial year at 5.4%. However, for the next financial year, the projection is kept at 4.5%. Now, the full year projection, which was kept at 5.4%, was basically on account of what we say is that volatility in food production, which the MPC, the governor highlighted. That has also one of the reasons that kept the MPC on hold rather than taking a bold call and to announce some softening. So that is where the volatility keeps coming in, but the core inflation has continued to trend downwards. Now, if you look at the quarter by quarter number for the next financial year, so for the first quarter it is it falls to 5%. Then second quarter 4, then again it moves to 4.6 and 4.7. So for the full year, it is expected to average around 4.5%. Now, core inflation, which I just mentioned, has started to moderate. Now, headline inflation stood at 5.69% in December 2023, and it has always it came down to 4.87%, but again moved up to 5.5 and then 5.69%. So the headline inflation is driven largely by your food inflation, which has remained quite volatile, and typically we have seen that vegetable prices actually impact the headline inflation to a large extent. So similarly, the cereals have also impacted the headline inflation. So this is one aspect where the volatility is expected to continue. Core CPI, which where if you take out the food and fuel from the headline inflation, has moderated to 3.9%, which is actually lower than the 4% mark, which the MPC is actually targeting there. So it has remained along 4% for some time now, 4.52, 4.26, 4.1, and then again 3.9. Now the disinflation in core gathered momentum during September, October, which the data is also showing, and reached levels last seen during Q4 2019-20. Due to combined effect of policy rate increase, we have the MPC has increased by 250 basis points, and obviously reduction in cost put pressure across core goods and services. So all the the sectors, subsets, everywhere in terms of the core inflation has started to see a downtrend. It is not only one segment, across it is seen. And non-core inflation was higher in November and December due to volatile food prices. So if you break up the entire inflation in core and non-core, so core has started to trend downward because of the reasons that I mentioned. Non-core has remained volatile because of food. So this is expected to continue going forward. But going forward in the next financial year, it appears that even the food inflation is expected to come down, because the assumption here is that monsoon is going to be normal. This is what the various data points are showing, that monsoon is expected to be normal in the coming financial year. Crude oil prices, despite all the Middle East wars and sanctions on Russia and other things, has remained between $75 to $80 a barrel. So in fact, this is one factor which has given a lot of comfort to our projections in terms of projecting how the inflation is going to move going ahead, because this clearly shows that demand for oil has remained not very robust, because the China has started to disinflate. Also, a lot of crude has started to flow from Venezuela. So crude oil prices are expected to remain in this zone, because this impacts globally to everyone. So all the countries would like to see that it remains in a range of $75 to $80 a barrel. Now, what are the risks that we run to our projections on inflation? As I have been mentioning, that adverse weather conditions, it impacts food drastically, and with close to 50% weightage in CPI inflation to food, it typically tends to spike too much at points of time. Supply side shocks could be there in terms of both food and fuel, as I've seen, because of the geopolitical risk, and global commodity and food price outlook. They are a risk, but at this juncture, both look benign. They are not looking to spike, suddenly. But yes, we cannot overlook the risk that they pose to our projections to inflation. So, two things: growth is very resilient, is moving ahead at upwards of 7%, and inflation is moderating. So definitely, the entire macroeconomic picture for the domestic market looks very attractive. The third aspect or the third pillar of any MPC is obviously liquidity, because that impacts the shorter term rates more than the policy rate. So before this policy, markets were expecting that the RBI would announce a measure to ease the liquidity. However, the RBI decided to keep the liquidity back to where it was earlier before this policy, on a tighter side. So after remaining in surplus during April-August 2023, it was surplus, the liquidity was surplus. That time we saw that the overnight rates used to keep falling below 6.5 levels. 6.5 is the policy rate. So it used to remain between 6.25 to 6.5. But it turned deficit from September after a gap of 4.5 years. Now, after that, what we've seen is that liquidity deficit, started to trend upwards. Deficit reached closer to 3.5 lakh crores, and our overnight rates shot up to the upper band, which is at 6.75, and it remained there for a very long period of time. For the last few months, we have seen that. In fact, today also it was at 6.65. So, because of this deficit, the short-term rates remained there. So the expectation was that RBI would use some tools or provide some direction to ease this tight liquidity. However, what was also noted was that the government had not spent the cash balances which they had. So adjusted for government cash balances, potential liquidity in the banking system still in surplus. So the government's cash balance with RBI had touched closer to 3.8 lakh crores. So which they started to spend in the last fortnight. So we saw that the overnight rates dropped to closer to 6.25 again. However, in order to keep the rates tight, because it impacts the inflation, so RBI has again used the various tools of VRRR, injecting liquidity and withdrawing liquidity to keep it back towards the policy rate. So what RBI has mentioned that they will keep to do fine tuning so that repo operations to ease liquidity easing and tightening, so that the overnight rate remains closer to the repo rate, which is at 6.5. Now, with government spending picking up and augmenting system level liquidity, in fact, RBI undertook 6 fine tuning VRRR, which is that auctions during February 2 to 7, which is basically withdrawing liquidity from the system. VRRR means I am withdrawing liquidity from the system, so that the rate went up, came down, which had come down to 6.25, went back to 6.60, 6.65 levels. What RBI has mentioned in today's MPC is that they will remain nimble and flexible in its liquidity management through the two-way fine-tuning operations in both injecting as well as absorbing the liquidity. Because as I mentioned, the MPC and RBI both are expected to remain extremely cautious in terms of their policy measures. So liquidity tightening and or liquidity very easing, both sides impacts the economy. So they would like to keep it at somewhere around the repo level. In terms of the INR, it has remained stable compared to both its emerging market peers and a few advanced economies that we have seen. So INR has remained somewhere around 83 for a very, very long period of time. So obviously, RBI has been intervening and managing the volatility in the forex market. In terms of the coefficient of variation, INR exhibited the lowest volatility in 2023 to 2024, basically April to January, compared to the corresponding period in the previous 3 years. This was obviously because of lot of flows have also come in, and that has also helped the INR. But in order to keep the exchange rate to real exchange rate to neutral, RBI has undertook used various tools and intervened in the forex market to keep it around 83 levels. That's what we have seen. So that's also one aspect which helps RBI to manage the liquidity in the domestic system. There were some statement on development and regulatory policies. Basically, it was more on disclosure norms, basically. So requirement for lenders to provide their borrowers a key fact statement containing the key information regarding a loan agreement, including all-in cost of the loan, in a simple and easy way to understand format for borrowers for all retail and MSME loans. More disclosures, ease of understanding to the borrowers. These would be has been further expanded. Enhancing the robustness of Aadhaar enabled payment system. All those payment systems have been done more robust. Review of the regulatory framework for electronic trading platform, which is again in terms of the transactions which are happening. Introduction of programmability of offline functionality in central bank digital currency, because the RBI is trying to deepen the central bank digital currency transactions. So they wanted to deepen it further and taking some further measures on that. Framework for authentication of digital payment transactions with more innovations coming in. So there would be more frameworks on that. Hedging of gold price risk in over-the-counter market in International Financial Services Center to enhance more flexibility and easier access to derivative products in hedging their exposure to gold prices. So number of development and regulatory policies to ease the transactions and further make the regulations robust. These were mentioned by the RBI. Now, one aspect which we have been reading or we have been highlighting for some months now has been the inclusion of Indian bonds in global bond indices. Obviously, in September 2023, JPM announced that it would be included. Then in January again, Bloomberg announced its proposal to include Indian bonds in the Bloomberg Emerging Market Local Currency Index from September 2024 over a phased 5-month period. Now, these are the measures which we have seen. So we have seen first JPM coming in, then Bloomberg. So what we expect is that with these two main bond indexes, including the sovereign bond in their bond indices, more such indexes would start including the G6 or the sovereign bond in their indices. So we expect more inflows to come in over the period of time. So as we had seen that inclusion in JPM would result in inflow of closer to 25 billion over a phase period. Inclusion in Bloomberg would result in inflow of closer to 3 billion. So these are all extremely positive developments. And in terms of inflows, these are very, very positive. Now, one impact of these decisions which were taken in September and January, what we have noticed is that before actually the passive money starts to flow in, the active money, which which are like hedge funds or people who want to play around with the interest rates, these money starts to come in much earlier than the passive money flows in. And this has been visible in the last 2 months. So in the last 2 months, we have seen substantial inflows coming in, and lot of money has come in, and it has been invested in very long bonds, that is 30, 40 and 50-year bonds. So that's one reason that we have seen, or we must have noticed, that the long-term bond yields have actually fallen much more than the short-term bond yields. So today, 30, 40 and 50-year bonds are trading somewhere around 7.11 to some 7.13 levels. These have been trading. So there has been substantial inflow in this segment of the bond market. So obviously these are the what we call is active money, which try to make money out of these policy measures or these inclusion indexes. So they have started to flow in. So that is again a very, very positive sign for Indian domestic market, for the rates market and the GSEC market. So there is also a possibility of inclusion of IGB in other leading global bond indices in future. So what we could see is that more and more such things happening and more inflows coming in the bond market. Moving from there, this chart shows that the foreign bond inflows had spiked to a 6-year high. So obviously this data is only up to December, and foreign investment in IGV saw a remarkable jump in the last 3 months of 2023 with the JPM's decision to add to the debt to its indexes, as I mentioned. So money has actually started to come in. So overseas investors net bought G6 of close to 35,000 crores in October, December, pushing the full year tally to 59,800 crores. That is almost close to $8 billion, if I can say somewhere around that. And it is expected to continue to add more and more as the time passes. So in fact, for the April till January end, or rather 6th of February, what we have seen, both the equity and debt put together, the inflows are closer to $32 billion. So that obviously includes substantial amount of in equity, but also close to 8 to 10 billion dollars in the debt market also. So we expect this trend to continue going forward. Now, with all these policy measures, with MPC being on hold, our projections, the MPC's projection on growth, on inflation, various inclusion in government bond indices, how do we see the bond markets going ahead, or why do we say that it looks attractive? So I'll just mention certain points. So first and foremost is that you must have seen that when on 1st of February the budget was announced, the biggest movement in the bond market was that the budget projected fiscal deficit at 5.8% for this financial year, though it has been pegged at 5.9% when the budget was announced. So obviously there is a improvement in the fiscal deficit target. So it is 10 basis lower than what was budgeted. So it is expected to get 5.8%. So what it shows is that the government's credibility to move towards a very fiscally prudent. So for the next year, financial year, so government has targeted a fiscal deficit of 5.1%. Markets were expecting somewhere around 5.3%, but the finance ministry actually surprised the markets by announcing that the next year the budgeted estimate for fiscal deficit is at 5.1%. Not only that, the gross borrowing for FY25 is lower by 1,30,000 crores at 14.1 lakh crores, and net borrowing stands at 11.75 lakh crores. So it clearly shows that the government is on a fiscal consolidation path. So that is very, very healthy for the bond markets, not for the domestic market also, but also when the investors look from the overseas market also, when the FIs look at how fiscally responsible we are becoming and trying to move our fiscal deficit towards the 4.5% mark, which has been by FY26. So that this announcement actually there was a massive rally in the bond market. So the long end yields fell by 25 basis. I'm talking about a 50-year bond. Similarly, a 10-year bond fell by close to 10 to 15 basis points. So this is one of the major factors which gives a lot of confidence in the domestic bond market and the macroeconomic picture. So we expect the the rates to continue going down with this fiscal consolidation move which the government has started. The real policy rate continues to be positive. Repo rate is at 6.5 and projected inflation is at 4.5. So close to 200 basis real rate is there today. If I can look at or assume that there is no rate cut. So obviously it opens up or tells me that there is enough room for MPC to cut rate. In fact, today one member emphasized that the time is now to cut the rates. Global central banks have put a pause on rate hikes that we have seen. The Fed has put on hold. Bank of England has put on hold. In fact, the entire central bank, if you see globally, they have put their policy rate hike on hold. So the narrative has changed from rate hikes to rate cut. Now the timing is only the issue, which can be any time, maybe the by June or by May, or depending upon the various incoming data points. But please note that the entire narrative has changed from tightening to softening. So that's how the markets are looking at the interest rate market. RBI is to ensure adequate liquidity for productive requirements. Our forex positions is very, very comfortable. India's external vulnerability indicators, which is external debt to GDP ratio, reserves to external debt ratio, reserve cover of imports, exhibit higher resilience in comparison with EME peers, as well as since the taper tantrum period of 2013. So external sector has remained very resilient and robust. So in fact, one of our weaknesses had always been the 2 points which had been the weakness was fiscal deficit, which obviously is being tackled, which we have seen by the numbers. And the second was current account deficit. So with the flows coming in and with the various policy measures and the inflation coming down, what we have seen is that our current account deficit is expected to remain very, very comfortable. It should be somewhere around closer to 1% to 1.5% this financial year, full year, and going forward also. So that is again something which we can be quite confident that it can be easily managed. That is a very healthy deficit to manage. So from external sector vulnerability, we are very, very comfortable. So there is enough room again here for MPC to cut the rates, because from the fiscal side you are quite comfortable, because the government has started to reduce the fiscal deficit, reduce the borrowing, and your external sectors are healthy. So obviously there is enough room for MPC, or quite comfortable to ease or loosen. So from the monetary aspect, there are enough room to cut the rates. Inclusion in India IGBs in global bond indices would definitely support the yields. So we just saw a small trailer of some money coming in, flowing in, and getting invested in bond market, and how the yields rallied in the long end. We expect it to continue and support the yields going forward. Core disinflation has been steady, indicating of the impact of past monetary policy actions, and obviously the easing of cost push inflation. Global geopolitical crisis can adversely impact freight rates and lead to supply side issues. What is very encouraging to understand here is that everyone is impacted by this. So globally, all the players, all the countries, largely the US, is actually working on that to minimize that. So this may not spiral out of control. What we understand is that it could be contained. It may prolong for a long period, but it would be contained. That is what our assessment is. Markets are expected to remain volatile in the near term. That's what we saw today. But the markets are reading that RBI has been cautious, but definitely rate cuts are definitely there going forward in the next 3 to 6 months. If you look today, our absolute yield levels are very attractive, both from the absolute levels as well as real levels from a medium to long-term investment horizon. And as I mentioned, the NPM gains to accrue as the rate starts to soften going over a period of time. So in our assessment, we expect that the Fed to start the cycle of rate cuts, and then we can see the MPC to start following the footstep of cutting rates. So somewhere around by that we'll meet again, the MPC meets again, say February, then again April, and then April again, then June. So we could expect by June for the MPC to start cutting rates. But what we have seen is that market starts to react much before that, and we could see that rates to start trending downwards much before actual rate cut starts to happen. So all in all, the market looks very attractive for the bond markets, for the interest rate markets for this financial year. So That's in a nutshell how we look at the bond markets going ahead. So thank you. I'll hand it over to Ishan for Q&A. If you have any questions, I'll be happy to answer.
Thank you, Parisa, for those insights. We have a couple of questions. I'll take them up one by one. The first one is the headline CPI inflation is projected at 4.5% for the next financial year, still above the 4% level. So, how do we see that?
Yes, see, 4.5% is a projection today. And obviously, these are iteratives. Incoming data will continue, will keep on you projecting your inflation data going forward. So as of today, we have projected at 4.5 or MP is projected at 4.5. But with the softening of core inflation and the impact of 250 basis points taking shape in the economy, the it appears that inflation will actually move towards the 4% mark. Now, please try to understand is that the MPC guideline is still between 2 to 6%. They are trying to bring it towards 4%. It is not a tight estimate. It is what one has to read is that on a durable basis closer to 4%. So that's how we see that 4.5% could be lower than that, but can remain there, but it would open up a lot of room for MPC to cut rates going forward.
Understood. So, the next question is can we expect a rate cut in Q2? As also the RBI projection in for the quarter two is at 4%, inflation touching 4%, and also the Lok Sabha elections would be out by then.
Quite possible, it can happen. But as I had mentioned, first the Fed has to bite the bullet. Then obviously because that is where the key decisions would be taken because it impacts our INR. So that is where our assessment is that. So first the Fed would do some easing, and then the MPC would take a call. It may happen that yes, even if they do not cut the rates, they will change their stance to neutral, which will give a signal that it's almost done now.
Got it. So, what is the benchmark yield we see during or ahead of the rate cuts?
Ahead of rate cut. See, today benchmark we are closer to 7.06 or 7.07. With a lot of flows coming in and markets expecting that rates to soften going ahead, we may see it coming below 7% also. But in the very near term, we expect it to remain in the range bound, in the same way, say 10 basis points. So obviously, one or two cancellation of options because we are at 5.8% the fiscal deficit, or there's enough cash balance with the government. They do not want to borrow more. So what would happen is that if they cancel one or two auctions, we could see that the rate to fall below 7% very quickly also.
Got it. So also our projection, how do we see the rate cuts for this next fiscal year? How much quantity of how much do we see the rate cuts for the next fiscal year?
See, if you look at very objectively, so if I go by what projection RBI has given, 4.5, that is the inflation target. So obviously, a real yield should not be more than 1 to 1.5% or wherever, because then it becomes very restrictive for the economy. In fact, one MPC member has highlighted that in a growth economy like India, the real yield should not be more than 1%. So, it's a 5.5. So even if I'm assuming that rate cut could be between 50 to 75 basis going forward. So if I assume that it can be kept at say 5.5 or 5.75, so obviously 75 basis rate cut, 50 to 75 basis rate cut in the next financial year is definitely looks quite probable.
Got it. Got it. So, is it a good time to enter bond funds currently? And if yes, then what can be an investment horizon for the same?
Yes, it is still a good time to invest in bond funds because time horizon should be at least for more than a year and a half, because obviously we do not see the full impact happening within next 3 to 6 months because it will depend upon the data. So all the bond funds where the durations are higher are look very attractive because A, your yields are still closer to, the average white teams are still around between 7 quarter to 7.5. And if someone is running a duration of closer to 5 to 6 years and 50 basis rate cut happens, ballpark figure looks, if you add somewhere around 7 and then to 2.5, looks quite attractive.
Got it. Got it. Thank you, Pari sir. We don't have any further questions. Thanks everyone for joining in, and we'll see you next time.
Thank you.